Good afternoon, everyone. This is Christian with PerfectStockAlert.com, a 100% free service for smart investors and traders. All we ask in return, please refer a friend. Today we're going to be looking at short-term investments, also known as marketable securities. As I do in each one of these fundamental analysis tutorial videos, I'll give you the actual definition, and then we'll go on to look at some examples and give you a little more insight. Short-term investments is an account in the current assets section of a company's balance sheet, also known as marketable securities. Investments in marketable securities are easily convertible to cash, which a company plans to hold for no longer than 12 months. Stock in a private company would not qualify as readily convertible to cash, and therefore would not be listed in short-term investments. Now let's look at some examples. Okay, I'm now looking at the balance sheet here on Yahoo Finance. You can find a balance sheet for a publicly traded company almost anywhere. Google Finance will give it to you, MSN, your discount broker, any company you might be trading. You can go online on their individual websites and look up under their investor relations section. You'll probably find the annual report along with the balance sheet, income statement, and cash flow statement. So right now, like I said, we're looking at the balance sheet, and I'm going to be looking underneath the assets, the current assets. And these, of course, are going to be anything in the current asset will be items which can be liquidated within 12 months. Basically, they are the most liquid items. And of course, the most liquid on that list will be cash and cash equivalents. And then below that, the item right after that, the second most liquid, would be short-term investments. Now, we mentioned in the last video talking about cash and cash equivalents that that's one of the key elements you're going to look at in the balance sheet. Cash is very, very important to a company. No matter what it wants to do, it needs cash to do it. If it wants to pay a dividend, it needs cash. If it wants to keep the lights on, it needs cash. If it wants to turn around and continue to run its business, it needs cash to buy inventory, then sell that inventory, turn that into net receivables, which then gets turned into cash again. You just turn this awesome cycle. Whenever a company builds up this cash, it gets to a certain amount that it's far exceeds anything that's going to be needed in the short term, and so they basically create or they start looking for a way to increase the return on that cash, and so they'll oftentimes turn it into short-term investments, basically stocks and bonds. And again, these have to be convertible, they have to be two things. Number one, they have to be easily or readily capable of being turned into cash. That's why a private or stock in a private company wouldn't qualify. Securities and publicly traded companies would qualify because you could argue, I intend to liquidate the position within inside of 12 months, and sometimes that will happen. So that would work. And you also know that publicly traded companies are very easy to liquidate. Bonds would also work as long as the actual maturity was within 12 months. That would also work. Now remember, treasuries could work here as well. The only treasuries that will fit up here are those that will mature within inside of 3 months. So anything longer than 3 months but less than a year could fall here. Now again, a company that is a very strong cash position will often have a lot of cash, and they'll also have short-term investments as well. It's just basically another place where they can stick that cash and get a better return than they would in a CD or a savings account or a checking account or something of that nature. So that's something to think about whenever you're looking at a company that has a strong cash position and a strong short-term investments position. They are cash rich in that situation. At least in many cases, that's what they're going to be showing you. In this particular example, you will notice that we don't see anything here under short-term investments. Doesn't necessarily mean it's a bad thing. It's just something to keep note of, that this company, if they were to run into a cash tight situation, they don't have a backup on the cash right there, the short-term investments. So that's something that will make it a little weaker than maybe a competitor that would also have a short-term investments section. But you also notice this company consistently doesn't have it. So you have to go and look, but sometimes companies feel that their cash is better spent elsewhere, either expanding their business or paying off their debt or something of that nature. So it's important to note that short-term investments does improve a company's current position, current assets, because it's going to give it a lot more strength to weather any storm, because it's going to have a lot more cash available to them. But it's not the only thing that somebody can do or management can do with their company's cash. Okay, now you know. One other item I'd like to point out here before we wrap this video up. The two tenets required for short-term investments is, one, they have to be readily capable of being turned into cash. So if you have securities, that you have to be able to turn them into cash, and you want to be able to do that within 12 months. However, that 12-month just means you intend to do it within 12 months. So let's say a company saw that their current assets were getting a little low and they wanted to keep their ratios looking good. Management could just as easily say, okay, I'm going to take some of these long-term investments here and I'm going to say that I intend to liquidate them inside of 12 months. Well, then all of a sudden, if they had long-term investments here, it would just get moved right here. All of a sudden, you've just finagled your current assets or improved them just because you, quote-unquote, intend to liquidate them inside of 12 months. There's different things that company management can do here to alter their balance sheet and their liquidity ratios and things like that. So it's important to note. Clean that up. Should also be noted that a company, if they were going to report quarterly on the short-term investments, you could see, especially if you had something like securities in short-term investments like stocks, they're going to every quarter come out and tell you what the value of those positions are, but they're going to be based on as though they were liquidated at the current price, so the current market value. So you can see some fluctuation in short-term investments pricing as well from one quarter to the next based on the market that the company may be invested in. If they're talking about securities like stocks, something like that. Okay, and now you know. Please take a moment to review our disclaimer. The information provided herein is our opinion only. Under no circumstances do any statements here represent a recommendation to buy or sell securities or make any kind of an investment. You are responsible for your own due diligence. To summarize, we do not provide investment advice, nor do we make any claims or promises that any information here will lead to a profit, loss, or any other result. These videos are for educational purposes only.